Sometimes the biggest changes in the world happen, well, quietly. Not with a bang, but with a memo that sends these tremors through the entire global industrial landscape. Today, we're diving deep into the paper trail behind one of those moments. We're looking at a brand you definitely know, Subaru. For decades, it's been one of the Japanese automakers most tied to North American roads. But something just changed. Subaru stopped making vehicles in the United States that were meant for the Canadian market. They moved that whole operation back to Japan. And this is so much more than just a little supply chain hiccup. Our mission today is to analyze this huge geopolitical shift. We're studying sources that show how a major U.S. policy, one designed to, rebuild domestic manufacturing, ended up doing the exact opposite.
That's really the core of it. This isn't just a business story. It's a geopolitical one. This decision by Subaru, it's a signal. What our sources are documenting is how policy volatility, this sudden punitive mindset in Washington, became so damaging that huge corporations are now redrawing their maps to avoid it.
So stability has become the most valuable currency.
It absolutely has. And in this story, the predictability offered by Canada started to look like the safest bet on the entire continent. I mean, for nearly a century, U.S. manufacturing was the benchmark for stability. Now we're seeing what some top economists are calling reverse reshoring.
Reverse reshoring.
Right. It's the ultimate policy failure. Measures designed to bring industry home are instead pushing it offshore, or in this case, just straight north. Subaru is just the most visible example of this much deeper change.
Okay, let's unpack this. We have to start with the direct cause because the sources are incredibly clear on this. This move by Subaru is a direct consequence of the tariffs imposed by the previous administration.
Specifically, that 25% tariff on imported automobiles and, crucially, on metals.
And the whole goal of those tariffs was protectionism, right? A promise to bring jobs back, to spark this renaissance in American manufacturing. But the reality, when you look at the financial reports we reviewed, tells a very, very different story.
Well, the logic for Subaru's move is all about input economics. It's pretty straightforward, really. When the tariffs hit not just finished cars, but the key inputs, things like specialized steel and aluminum, the price of those materials just shot up inside the U.S. market.
So it wasn't just about the final car.
No, and that's the key. It immediately made domestic assembly way less competitive.
Yeah.
Modern manufacturing, it runs on these finely tuned, just-in-time supply chains. When the cost of your core materials jumps 25% overnight, the entire production model just, it breaks down.
So for Subaru, it became cheaper to just build the car in Japan.
It became mathematically cheaper to ship a fully assembled car from Japan directly to Canada than it was to build it in their U.S. plant and then move that tariff-inflated car across the border.
That is just a shocking inversion.
It is.
A policy designed to make made in America the best option created a situation where importing was actually cheaper than building locally. But what about the U.S. steel industry? Wasn't it supposed to benefit?
That's the critical detail everyone misses. Sure, the domestic steel industry might have seen a brief, immediate benefit, but the price inflation that followed hurt every single downstream manufacturer far more.
So car makers, appliance makers.
Everyone. One analyst we read described it as a self-inflicted wound. The cost to source, assemble, and ship a car made in the U.S. under those tariffs was just significantly higher than for competitors in tariff-free zones. This is the reverse reshoring effect in action.
So Subaru's move wasn't just a memo. It was a signal to the world that the U.S. was no longer the most predictable place to do business.
Precisely. The core problem was the, let's call it a confrontational mindset that made future planning almost impossible. These companies operate on 5, sometimes 10-year investment cycles. They're sinking billions into plants. They simply cannot risk that capital if they're worried that, as one expert put it, a sudden tweet will wipe out their margins overnight.
Let's talk about the consequences south of the border, because the scale of this it's huge. We're seeing real impacts in traditional American auto centers. U.S. factories in places like Chicago have had to pause or scale back, running at minimal capacity because of these tariff games and, weaker demand from higher prices. And the financial numbers are just staggering. General Motors, a titan of American industry, reported losses over $1.1 billion in a single quarter.
And that wasn't just a bad sales month.
No, it was directly linked to supply chain chaos, these sudden raw material cost hikes, and just pausing production waiting for some clarity on policy.
And they weren't alone. Stellantis lost something like $350 million in just 6 months. These aren't just little setbacks. These were deep cracks in the foundation of the U.S. auto industry.
Yeah.
The U.S., once the benchmark for stability, now looked more like a maze of overlapping tariffs. That was a quote from one of the sources.
And this is all happening while consumer attitudes are changing too.
That's the other side of the coin. The sources point out that the Buy American slogan is losing its grip. American drivers are choosing Japanese and Korean cars more and more.
For reliability and cleaner tech.
Exactly. When the political message doesn't match the product quality and your own policy is making your domestic product more expensive, well, that nationalist appeal fades pretty fast.
Okay, so let's pivot and look north. While the U.S. was tying itself in knots, what was Canada doing?
The contrast is stark. Ottawa's approach was deliberate calm. They avoided what the sources called the fiery rhetoric or emotional reactions.
A completely different strategy.
A very strategic choice. The Canadian government, under Prime Minister Mark Carney at the time, realized that waiting for Washington to sort itself out was a losing game. So they proactively went out and built new, more stable partnerships with Japan, Malaysia, even China.
So they didn't wait. They built an alternative.
They positioned Canada as the reliable alternative, just as the U.S. was becoming a source of conflict.
But did they just throw money at these companies? Was it all about subsidies?
And that's the interesting part. No, that's where the Canadian strategy was so different. Carney's government didn't offer these huge short-term subsidy packages. Instead, what they offered was a stable, predictable, and consistent policy framework. And for these companies, tired of the uncertainty, the source explicitly says, stability is worth more than any short-term support.
They were selling predictability.
They were selling predictability, not handouts.
And this framework got a name, right? The Carney Doctrine, or the Doctrine of Smart Trade.
Yes, and it's built on 3 pillars. First, just clear rules of engagement. Second, very strategic incentives, but aimed specifically at green manufacturing, things like big tax breaks for EV battery plants.
So future-focused.
Very. And third, a commitment to open digital borders for seamless data flow, which is, essential for modern supply chains. It was all designed to appeal to industries that need that long-term planning horizon.
And the results were immediate. Toyota sales in Canada jumped, 29% in a single month?
And analysts said it wasn't because of incentives, it was because of that perceived stability.
So Canada is now pulling in all this investment in advanced manufacturing, green tech, creating jobs in Ontario, Quebec.
It's a real shift. And this brings us back to Japan. For them, this was more than just a business decision. Tokyo basically came to a critical realization that relying so heavily on the U.S. for market access had become their single biggest risk. So they started rebuilding their networks around partners they could actually trust.
Which means we can see this physically redrawing the map of North American industry. We're talking Subaru, Toyota, Mazda, even China's BYD.
They are all restructuring their logistics to use Canadian ports as the gateway to North America, bypassing the U.S. entirely.
To ensure predictable entry and costs.
You can see it in the infrastructure. Vancouver is slowly replacing Los Angeles as the preferred port for electric vehicles coming from Asia. Montreal is becoming a hub for clean battery tech.
Canada is becoming a secure corridor.
A secure corridor linking Asia to the entire continent. And this was all cemented politically. At an ASEAN summit, Carney made it clear, he said, and I'm paraphrasing here, Canada will engage with the United States when it is ready, but Canada will not stand still and wait.
That's a powerful statement.
It was an assertion of leadership, telling the world there was another reliable partner ready for business.
So for you, listening to this, what does it all mean? We are watching what's being called the Great Reversal. The economic center of gravity in North America has shifted. As Canada is welcoming new factories and stable investment, the U.S. is struggling under the weight of its own policies.
The message from these automakers is really simple.
The road to the industrial future doesn't just run through Detroit anymore. That route now passes through Toronto, Vancouver, and Montreal. The map is being redrawn, and the arrows are pointing north.
I think it confirms that the world is no longer just waiting for the U.S. to lead. It's actively following this path that Canada has opened up. The sources really emphasize this one lesson. Trust, not threats, is the true engine of the modern economy. And in that economy, reliability is the most valuable currency there is.
And this global shift is forcing everyone to pay attention. Countries are turning away from the noisy promises of protectionism.
And choosing the quiet stability of real partnerships instead.
Every new factory, every new trade agreement just reinforces this new reality. The future is being built on consistency and long-term vision.
So here's a final thought to leave you with. If Canada-friendly is now the new shorthand for safe, forward-looking investment, what historical examples can you find where quiet, consistent strength won out over brute, unpredictable power in defining the world's economic axis? That's a fascinating question to explore.